Welcome to the world of value investing, a strategy that could potentially multiply your wealth even in the volatile realm of the stock market. Let's dive in. This concept at its core is incredibly simple yet astoundingly effective. Value investing is about finding and buying securities that are underpriced by the market. It's about identifying those diamonds in the rough, the stocks that are undervalued, and holding on to them until their true value is recognized by the market. It's akin to buying $1 for 50 cents, a bargain that you know will eventually pay. Unlike other investment strategies that focus on short-term profits, value investing is a long game. It's not about making a quick buck or chasing the latest trend. It's about careful analysis, understanding the intrinsic value of a company, and having the patience to wait for the market to catch up. But don't mistake this for some passive buy and hold strategy. It's far from that. Value investing involves active management, continuous monitoring of market trends, and adjusting your portfolio accordingly. It requires discipline, a keen eye for detail, and an understanding of financial statements and market indicators. You see, value investing is not about speculation or gambling. It's about investing in businesses, not just stocks. It's about buying a piece of a company and becoming a part owner. It's about understanding the business, its strengths, its weaknesses, and its potential for growth. And yes, it might not be as exciting or glamorous as day trading or cryptocurrency investing. There won't be any overnight riches or instant gratification, but the potential returns, the possibility of seeing your investment grow exponentially over time, that's where the true excitement lies. Investing is not a quick scheme to get rich. It's a thoughtful strategy that requires analysis, patience, and discipline. But once mastered, it's a game changer. Value investing is not about buying cheap stocks. It's about buying good companies at a price lower than their intrinsic value. Now, let's delve into the principles of value investing, which can be broken down into 4 key areas. Firstly, understanding the company. This involves studying the company's business model, its products or services, and its competitive environment. It's about understanding what makes the company tick and how it generates its profits. It's not just about looking at the balance sheet, but also understanding the story behind those numbers. Secondly, the company's intrinsic value. This is the real fundamental worth of a company, independent of its stock market price. To calculate this, investors look at things like the company's earnings, assets, and future growth prospects. It's not an exact science, but rather an estimate based on available data and reasonable assumptions. The third principle is the margin of safety. This is the difference between a company's intrinsic value and its current market price. The bigger the margin, the safer the investment. It's like buying a dollar bill for 70 cents. This margin provides a cushion against potential losses, especially during market downturns. And finally, patience. Value investing is not about making quick profits. It's about holding on to stocks for the long term, waiting for the market to recognize the company's true value. It's about resisting the temptation to sell when everyone else is selling and to buy when everyone else is buying. These principles are not standalone concepts, but work together in harmony. Understanding the company helps you estimate its intrinsic value. The margin of safety protects you from overpaying for stocks and provides a cushion against losses. And patience? Well, patience allows you to reap the rewards of your good investment decisions over time. Value investing is not just about numbers and ratios. It's about understanding a business and its value and having the patience to wait for the right opportunity. Patience, dear investors, often turns out to be the most rewarding virtue of all. Benjamin Graham, the father of value investing, once said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." These words encapsulate the essence of value investing, a philosophy that Graham himself pioneered. Benjamin Graham was not just an investor, but an economist and a professor. He believed in the power of investing based on intrinsic value. Graham's strategy was simple: buy stocks that were priced significantly below their intrinsic value. This approach was akin to buying $1 for 50 cents, a strategy that made him one of the most successful investors of his time. Graham's philosophy was grounded in the belief that the stock market is often irrational. In the short term, it is driven by emotions, causing wild swings in stock prices. But in the long run, the true value of companies is recognized. This belief led Graham to focus on a company's fundamentals, its assets, earnings, and dividends, rather than its stock price. Graham's approach to investing was not about speculation or trying to time the market. It was about finding value where others didn't and having the patience to wait for the market to recognize it. This philosophy is beautifully encapsulated in his book, The Intelligent Investor, where he laid out his principles for successful investing. Perhaps the most powerful testament to Graham's influence is his most famous student, Warren Buffett. Buffett studied under Graham and has applied his principles to become one of the most successful investors in history. Buffett's success, in many ways, is a validation of Graham's approach to value investing. As we delve into the world of value investing, it's important to remember that it's not a get-rich-quick scheme. It requires patience, discipline, and a deep understanding of a company's value. But as Benjamin Graham demonstrated, it's a strategy that can yield significant rewards over the long term. As Graham demonstrated, value investing is not about following the herd. It's about making informed decisions based on sound principles. So, how can you apply these principles to your own investing strategy? Let's take a trip down the investing lane and explore this together, shall we? Our first stop is research. Understanding the company you're investing in is paramount. This isn't about just skimming through quarterly reports and earnings calls. It's about delving deep, understanding the company's business model, its competitive advantage, its future prospects, and its management. It's about becoming an expert in that company. So roll up your sleeves and get ready to do some serious homework. Next, we calculate the company's intrinsic value. This is the perceived value of a company's future net cash flows, discounted back to the present day. It's like peeking into a crystal ball and predicting the company's future earnings. But remember, this isn't about exact numbers. It's about getting a ballpark figure to guide your investment decisions. Then we look for a margin of safety. This is the difference between a company's intrinsic value and its market price. It's like a safety net. If the market price is significantly lower than the intrinsic value, that's your cue. It provides a buffer against potential losses and increases the potential for substantial gains. It's like buying a dollar bill for 50 cents. Finally, we come to patience. This is where the magic happens. The stock market isn't a get-rich-quick scheme. It's a place where patience pays off. It's about waiting for the right opportunity, for the market to recognize the company's true value. It's like fishing. You'll have to wait for the right moment to reel in your catch. So there you have it. Research, calculate, look for a margin of safety, and be patient. These are the steps to applying value investing principles. But remember, each step is crucial. Each step contributes to making a successful investment decision. Remember, value investing is a long-term strategy. It takes time and patience, but the rewards can be substantial. It's about playing the long game and winning. Patience is not just a virtue. In value investing, it's a necessity. The stock market is not a sprint, it's a marathon. And in this long-distance race, the tortoise often beats the hare. Consider the story of Warren Buffett, one of the most successful investors of all time. His strategy was simple: buy and hold. He didn't jump on the latest trends or panic when the market dipped. Instead, he patiently waited for the right opportunities, invested in companies he understood, and held onto those investments for the long haul. The result? A net worth of billions built over decades. Similarly, the late Sir John Templeton, another legendary value investor, once said, "The four most dangerous words in investing are This time, it's different. He understood that patience and discipline were key to successful investing. He didn't let market hype or fear sway his decisions. Instead, he waited patiently for opportunities to buy great companies at good prices. But why is patience so critical in value investing? Well, because it takes time for the true value of a company to manifest in its stock price. Market fluctuations, driven by short-term trends and sentiments, often distort a company's true value. By being patient, value investors can capitalize on these distortions, buying when prices are low and selling when they're high. On the flip side, impatience can lead to poor investment decisions. It can make you buy high and sell low, the exact opposite of what you want to do as an investor. It can also make you susceptible to market hype, leading you to invest in overvalued companies or sectors. In the end, patience isn't just about waiting, it's about waiting wisely. It's about doing your homework, understanding what you're investing in, and being confident enough in your analysis to stick with your decisions even when the market is testing your resolve. In the world of value investing, haste makes waste. So take your time, do your homework, and wait for the right opportunity. Your future self will thank you.